Why 73 is the age the IRS starts taking your money back. For decades, that money sitting in your IRA and your 401k was yours to grow, tax-deferred on your own timeline. You decided when to contribute, and largely, you decided when to touch it. But at a certain age, that arrangement ends. Whether you need the money or not, the IRS requires you to start taking it back out and taxing it every single year for the rest of your life. That age, for most people right now, is 73. And I want to be upfront that this number isn't the same for everyone. If you were born in 1960 or later, your number is actually 75, thanks to a law called Secure 2.0. So the very first thing you need to know is your own exact number, not just the one you've heard mentioned most often. Here's what we're covering today, friend. I'm going to show you exactly how this required withdrawal amount gets calculated, walk you through a mistake that catches a lot of people in their very first year of these withdrawals, and give you a simple framework so you're never caught off guard by this. And by the middle of this video, I'll show you the one mistake that triggers a massive penalty if you get your very first required withdrawal wrong. Before we get into it, if you haven't already, go ahead and hit that subscribe button. I put out a new video like this every week, walking through exactly the kind of retirement rules that quietly control your money, whether you're paying attention or not. And if you know someone approaching 73 or 75, share this with them now. This is exactly the kind of deadline that's easy to miss until it costs you. I'm Anne, and for years I've helped people understand what actually happens to their retirement accounts once the rules start requiring things of them. Let's talk about why the IRS starts taking its money back. Why RMDs exist in the first place. Here's the deal you actually made, even if nobody explained it quite this way at the time. When you contributed to a traditional IRA or 401k, you got a tax deduction that year. The government essentially said, fine, we won't tax this money now, but we will tax it eventually, once you take it out. That's the entire premise of a tax-deferred account. It's not tax-free, it's tax-delayed. For most of your working life and even into early retirement, you got to decide when that delay ended. But the government isn't willing to let that deferral go on forever. Eventually, they want their tax revenue, and required minimum distributions, or RMDs, are how they force the issue. Once you hit your RMD age, you're legally required to withdraw a minimum amount from these accounts every year. And that withdrawal counts as ordinary taxable income, whether you spend it, save it, or reinvest it right back into a regular brokerage account. And here's the part that catches people off guard. This forced withdrawal often lands right on top of other income, Social Security, a pension, part-time work, pushing your total income higher than you expected in exactly the kind of bracket stacking pattern we've talked about on this channel before. The money isn't extra income you asked for. It's income the IRS is requiring you to generate on their schedule, not yours. How your RMD age is actually determined. Let's get specific, because 73 isn't a universal number, and assuming it applies to you without checking is exactly how people get their first RMD wrong. Under the current rules from Secure 2.0, if you were born in 1951 through 1959, your RMD age is 73. If you were born in 1960 or later, your RMD age moves to 75. These thresholds have shifted twice in recent years through legislation, so even if you remember a different age from a few years ago, it's worth double-checking your specific birth year against the current rule. How the actual dollar amount gets calculated. Once you know your RMD age, here's how the required dollar amount itself gets calculated. And it's simpler than most people expect. Take the total balance of your applicable retirement account as of December 31st of the prior year and divide it by a number called your life expectancy factor, which the IRS publishes in a table based on your age. So if you have $400,000 in your IRA at the end of the prior year, and the IRS table assigns you a life expectancy factor of roughly 26.5 for your age, your required withdrawal for that year would be about $15,100. Every single year, you recalculate using the account's new balance and that year's updated factor, which typically shrinks slightly as you get older, requiring you to withdraw a slightly larger percentage of the account each year. Take a breath here because this is worth sitting with. As your factor shrinks year over year, your required percentage withdrawal grows, even if your account balance stays exactly the same. This isn't a one-time event. It's a growing requirement that continues for the rest of your life. The first year trap, the April 1st deadline. Here's the mistake that catches so many people in their very first year of RMDs. Normally, your RMD for any given year must be withdrawn by December 31st of that year, but there's a special exception for your very first RMD only. You're allowed to delay that first withdrawal all the way until April 1st of the following year. On the surface, this sounds like a nice bit of flexibility, but here's the trap. If you delay your first RMD into that following April, your second RMD is still due by December 31st of that same year as usual. That means both your first and second required withdrawals can land in the same calendar tax year, stacking on top of each other and potentially pushing you into a noticeably higher tax bracket for that one year. Exactly the kind of income stacking pattern we've discussed with other transition years on this channel. Harold's story. Let me tell you about Harold. Harold turned 73 and understandably wanted to put off dealing with his first required withdrawal for as long as possible. He'd heard he had until April 1st of the following year, so he simply waited until that deadline to take his first RMD. What Harold didn't realize was that his second RMD for the following year was still due by that same December 31st, just a few months later. So in that single calendar year, Harold ended up taking 2 full RMDs, his delayed first one in the spring and his regular second one in the winter, and both counted as taxable income in the exact same tax year. Harold's accountant delivered the news at tax time. Because both distributions landed in the same year, on top of his pension and Social Security, Harold was pushed into a meaningfully higher tax bracket than he'd ever occupied and owed several $1,000s more than he expected. Harold told me, "I thought I was being smart by delaying it. I had no idea it would double up like that." He wasn't careless. The rule genuinely is confusing on its face. He just didn't realize the trade-off hidden inside that flexibility. The penalty for getting this wrong. I promised you the mistake that triggers a real penalty, so let's talk about it directly. If you miss your RMD deadline entirely, or you withdraw less than the required amount, the IRS charges an excise tax penalty on the shortfall. Under current rules, that penalty is 25% of the amount you should have withdrawn but didn't. And while that penalty can sometimes be reduced to 10% if you correct the mistake quickly and file the right paperwork, it starts as a serious, immediate cost. This isn't a small late fee. It's one of the steepest penalties anywhere in the tax code, which is exactly why knowing your deadline matters so much. The framework. What to check as you approach this age. So here's your checklist, friend, as you approach this milestone. First, know your exact RMD age based on your specific birth year, 73 or 75, rather than assuming. Second, calculate this year's RMD amount early in the year using your account balance and the correct IRS life expectancy factor, so you're not scrambling in December. Third, if you're in your very first RMD year, decide deliberately whether to take it that same year or delay to the following April, understanding clearly that delaying creates a double RMD year for tax purposes. And fourth, set up automatic withdrawals or a firm calendar reminder well before December 31st, so a missed deadline never becomes a 25% penalty. Do you know your exact RMD age, or have you just been assuming it's 73? It's worth checking against your actual birth year today. Recap. Let's bring this together. RMDs exist because tax-deferred accounts were always tax-delayed, not tax-free. And eventually, the IRS requires that deferred tax to be paid. Your RMD age is 73 if you were born 1951 through 1959, and 75 if you were born 1960 or later. The amount is calculated by dividing your account balance by an IRS life expectancy factor that shrinks over time. And your very first RMD carries a special April 1st deadline option that can accidentally create a double income tax year if you're not careful, the way it did for Harold. Know your exact age. Calculate early. Decide deliberately about that first-year deadline. And set a reminder so the 25% penalty never becomes your problem. Here's the good news, friend. Once you understand that this is simply the other half of a deal you made decades ago, it stops feeling like the IRS reaching into your pocket and starts feeling like a predictable, plannable part of your retirement income, the same as your pension or your Social Security check. If this helped make sense of something that felt confusing, hit like on this video. Subscribe if you haven't already so you don't miss next week's video. And share this with anyone approaching 73 or 75 who needs to hear this before their first RMD deadline arrives. I'm Anne. Thank you for spending this time with me today, and I'll see you in the next one.